Big news today, Dr. Pepper, aka Dr. Pepper and Keurig, has just went out and bought Peet's Coffee. You know that company where they have that storefront where they're selling bags of coffee as well as little cups of coffee? Yes, them. They just bought them, and this is a play for their brand. It's strategic. But today, we're going to talk about what this really means for the company, who comes out on top, who wins from this deal. And additionally, we're going to talk about all of this drama that's happening, as well as the investing perspective. Is Dr. Pepper a good stock to buy today? Who knows? Let's see. So as you guys already know or may not have known, Dr. Pepper, aka Keurig as well, is also a beverage giant. They own companies like Snapple, sodas, different Dr. Peppers, you name it. They also got coffee pods from the Keurig brand as well. So Peet's, on the other hand, is a great synergy. So they are actually known for their premium brand coffee that competes at the same place and same space as Starbucks. You would actually probably know Starbucks more because they're huge and everywhere. I really only have maybe 3 Peet's in my area, but nonetheless, they're still pretty big companies. But the big question is, why would a company that is known for soda and pod coffee want a piece of Peet's? Now, the big thing that we're going to talk about today is diversification. Keurig Dr. Pepper really wants to expand their portfolio just beyond a soda into maybe a higher margin business like premium coffee. Number 2, we got growth. Growth is one of those things that you get with coffee consumption hitting record highs today. Americans drink over 500 million cups of coffee per day. Peet's already gives KDP that exposure into retail cafes and bagged coffee. So by having this synergy, maybe Peet's can then use their beans for Keurig pods, and then the distribution, which we'll get into next, gets a lot better. Number 3, distribution, or let's say the strategy for KDP. KDP already has one of the strongest distributions networks in the beverage industry, and by owning a part of Peet's, they really can put Peet's coffee in more grocery stores, more office machines, and maybe even expand their K-Cup lineup. So their K-Cup lineup right here is a bunch of different pods that they might offer in different flavors or different lines of coffees. So this is really interesting for them to actually get their feet wet into with the synergy from Peet's. So here's actually what happened, and KDP really took a minority stake in JDE Peet's, which is the parent company of Peet's Coffee. That means they don't fully own it, they just own a percentage of it, but they've got a seat at the table. Now, this setup really lets them set up for collaboration and strategy, share those resources, but still give Peet's that independence to run its own brand. Now, who wins out of this deal? There's a couple of winners and a couple of losers depending on how you look at it. A lot of people might say that Keurig will be winning out of this situation just because they get access to that fast-growing premium market in coffee. However, the stock has been looking a little bit negative today. A lot of shareholders don't like this move, given the reason that KDP is taking a significant debt financing stake to fund about $18 billion of this acquisition, and it's going to double its debt load to roughly $36 billion. Now, this is an immense amount for the company. In terms of ratios, their debt to equity ratio is about 70% or more. You really don't want to see a company take out that much debt, especially for acquisitions like this. These acquisitions have to pay off really well. If the synergy works well and all goes well, then it will be okay. But I think investors are seeing this as, what if the synergy doesn't work? You know, like Peet's Coffee and Keurig. What if those synergies actually don't work that well? And there's a lot of risk. There's a lot of unsecured risk that we're taking on by just offering this debt load to our shareholders. So shareholders may not like that at all. Now, on the other end, a winner could be Peet's Coffee. They actually get access to tap into KDP's distribution muscle in the US. They can get into these big box stores. They can share space with them in the shelves. They've already have their into these grocery stores or consumer staples markets where they're actually able to use that distribution, get their name inside of these stores where people can actually buy their beans and buy their coffee and actually use them and buy them more often. Because you know how difficult it is to find and compete for shelf space as a supplier of a product. It's very difficult, especially if you want that end cap. You need a big name for yourself. You need something that's going to sell. KDP may already have that locked in, and they can tap, as Peet's, can tap into that distribution network. Now, another party who also wins from this acquisition could be the consumers. The consumers are going to get a lot of more Peet's products coming into these K-Cups that they can use for their Keurig dispensers at home. You don't have to look that hard, and it's pretty easy to just find them. Now, the losers, this could be the people or the coffee brands that have to compete for shelf space. So now it's going to be very difficult to compete for shelf space if you are in this business. If you are in the coffee business, you're going to have to compete against Keurig pods, Peet's coffee, all of that. They're going to take more space. They're going to push you down the aisle. You're not going to be as seen close to the end cap. It might be more difficult to compete for that. So think about it like this. Starbucks is maybe the Apple of coffee, and if you think of Dunkin' Donuts, they might be like the Android, which is pretty simple. Everywhere, affordable. Now, Peet's, that is like the premium niche brand, kind of like the Teslas of coffee. Now, this deal is KDP's way of saying, hey, we want a piece of every kind of coffee drinker, whether that be the premium or the lower end side. So what should investors watch? They should really keep an eye on KDP's earnings calls. If they start highlighting coffee growth and Peet's integration, that is a sign of this deal really paying off. And the long-term story here is that KDP is transforming from a soda company into a diversified beverage powerhouse that is going to offer coffee. So, would you invest in KDP as a coffee play? Do you think that Starbucks will still rule this kingdom of coffee? Or let me know. Just drop your dots down below. Now, what I find really interesting when digging into Keurig Dr Pepper is that every single year, their growth for revenue top line has been growing very steadily, but very slowly. They're in the kind of like consumer staples brand here. But if you look at free cash flows, they dipped a little bit in the year of 2023, and they're kind of climbing back up. This stock really hasn't been doing much in the past year. It's down 14%. Shareholders aren't very too happy because of the drop today. The drop today is just immense. They've taken on this debt load. It's been going way above what investors intended it to. But in terms of free cash flow yield, they're getting a 4% free cash flow yield here. The price of free cash flow is almost the lowest it's been in maybe 3 years. And if you just look at this company in terms of the relative valuation, or like the valuation itself, it's not the worst, but not the best. There might be better opportunities for this valuation paying a 27 PE out there. Now, the number one company that you can compare this to is Coca-Cola, right? Where does Coca-Cola compare? Coca-Cola is reasonably cheaper at like 24 PE, price to earnings ratio here. Their revenue is growing at almost the same pace, but the free cash flows are down. Weighted average share is about the same. Debt's been a little bit increasing. I really don't know what's a better buy, Coca-Cola or Dr. Pepper. I personally probably wouldn't even touch both, just because this company is now free cash flow negative. Coca-Cola. I wouldn't even touch Coca-Cola right now. KDP, go back into KDP. At least this company has free cash flow, right? They're able to buy back shares, put money back into the business, and that's what you want to see. They're making these acquisitions to grow the business, and hopefully it pays off. Personally, I'm staying away from Keurig Dr Pepper, but all power to you if you guys are buying. Let me know if you guys are Dr Pepper shareholders down below. And what do you guys think of this video? Do you guys like these stock breakdowns and breaking down of these new acquisitions? Just let me know how you guys enjoyed today's video. Thank you guys so much for watching, and peace out.